It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome, welcome. This is Jill on Money, the program that takes the mystery out of your finances. I'm Jill Schlesinger, and Mark's running the show from the virtual studios. In fact, we are broadcasting from the Capital One Bank studios. Capital One, this is banking reimagined. What's in your wallet? Well, now, I cannot believe it, Mark. Here we are, September. It's almost like the middle of September already. The NFL is starting up. I had a wild experience of maybe like a pandemic. I almost lost my temper like crazy. I wanted to share this with all of you, and maybe you guys can help me out and figure out what the right comment would be to this. Ready? Let me set up the situation. You know, some of us are really lucky. We're working from home. And so, you have this moment where you can almost forget on a long weekend. This is what happened to me on Labor Day, that, life is really strange right now. And so I wonder, maybe because I hear from so many of you that, I have a little bit more of a connection to real world concerns. Anyway, I'm waiting in line for a coffee someplace, my local place. And there's two people in front of me, two people behind me. Woman comes running up and she goes, "Oh my God, it's emergency. Can I just cut in front of you?" And we all kind of look up and she says, and I look at her and she's wearing tennis stuff. And she goes, "I'm late for my tennis game." Ladies and gentlemen, this is not an emergency. I promise you this is not an emergency. So I thankfully was with a number of people in this line who sort of said, "No, get in the back of the line, dum-dum." And then she was absolutely just so exacerbated that we were so rude not to let her go. She goes, "I'm running late and I have people waiting for me." And I turned to her and I said, "Do you think that qualifies as an emergency?" And she goes, "I don't understand why you're being like this." And she almost has one of those like monologues to nobody. And I came within inches of just verbally knocking out this chick. Instead, I kept my mouth shut. I let the anger subside, but she did have to wait in line, so that was probably good. Anyway, that's probably about the worst behavior that I have encountered around this. Just completely ignoring life and what's beyond your 2 feet in front of you. I couldn't believe it. Anyway, she had a mask. Everyone was wearing a mask. So she was masked, but she was so entitled. She was so annoying. I wanted to slug her. I really did. And not that I'm a physical or violent person. I mean, I really meant verbally slug her. But I calmed myself down. Anyway, if you think that there was a better reaction to that, let me know, gang. This is the program that attempts to take the mystery out of your financial life, but I rely on my Jill on Money community to help walk me through this strange world. You guys can give me sort of the social P's and Q's. I'll give you the financial ones. Let's start with some questions. If you have a financial question, of course, please feel free to send us an email. Our email address is askjill@jillonmoney.com. Here's a note from Stuart who says, "We are totally at a loss on what to do with our portfolio and need advice from someone who isn't trying to sell us something." I know that's hard. "We are both retired. I'm 75. My wife is 72. We're worried about what a change in an administration would do to our portfolio. We're thinking of selling half of our stocks and mutual funds, both bond and income, fearing a substantial drop in the market and the possibility of increased capital gains taxes in a Democratic administration. I was told it would be helpful if I explained as much as possible. So here's what we have. Got a little bit more than $1 million, including investments and bank accounts. Most are invested in 2 management companies, a major portion in their IRAs. Gives me the breakdown. Large amount of cash and sold some stocks and mutual funds in 2019. Home is worth $450,000. We received 90 grand in annual income, 43 from Social Security, about 5,800 from a small pension, and then some money from a personal loan, Selling half of our portfolio would create substantial capital gain, would cut into our annual income. This is insane. Why would you do this? First of all, I mean, you have two things, okay? You have an allocation right now that is seemingly working for you. You've done pretty well. You've got a lot of money in cash already. So why are you looking? Why are you asking for more problems? And every time people say to me, "Oh, there's going to be a problem with this administration or that," it's just, I think, insane to try to outguess what's going to happen. Now, I agree that taxes might go up, but you've already sold a bunch of money, and you still need to have this money invested because it's hopefully going to last you for 15, 20 more years. So, no, I wouldn't do this. And before anyone else starts thinking about how they're going to outmaneuver the markets and guess what one administration is going to do or another. Just don't. Calm down, everybody, please. Okay. This is from Marianne, longtime listener. When everything happened in March, I was so happy that the two of you dedicated yourselves to your listeners and introduced the daily shows. Hey guys, you're listening here on the weekend, but we do have a daily podcast called Jill on Money. And Marianne writes, it certainly calmed me down. You are always the voice of reason. I'm happy to hear you're both taking a breather on the weekends now. We need to recharge our batteries. Okay, Marianne says, I'm 65 years old. I'll be 66 in November. Divorced, no children. I make $121,000. I do 15% into retirement, into a 403B, and 8% match. I'm a nurse in a busy department at my hospital. I love my work, but it requires a great deal of physicality. I'm going down to 3 days a week. It'll bring me down to $93,600 gross. I will do 8% of my 403B with the 8% match. I'll continue to do the max deposit into my Roth IRA. I rent. I'm planning to work until I'm 70. Awesome for this, Marianne. God bless you. And she will have Social Security, $3,600 a month, and a pension, another $1,000 a month. I'm partners with my sister in 2 rentals. The rents are covering the costs. Both properties have mortgages. I'm considering taking Medicare instead of paying premiums for the insurance offered through work, as I will be paying 30% more in premiums due to reduction in work hours. When I run the numbers, I'll need to pull about $1,000 from my account. I pay capital gains, no charge. When I retire, I will need $4,500 to $5,000 monthly for expenses. My financial planner wants me to consider an annuity. She sent me 3 proposals. She did recommend one in particular. I just read a 2016 article on annuities, and it specifically mentioned high fees attached, screenshots of investments. I hope you can find time to do this. Okay, so thank goodness Mark says we can go to a break because I had to go look at these attachments and come back and see whether or not this makes sense for you, Marianne. So during the break, let me look at all the attachments. Let me see what you have. And then we can figure out where to go from here. You know, my inclination always is to not do anything with an annuity, but we'll see. I got a break to figure it out. You're listening to Jill on Money. If you've got a financial question, just send us an email. Ask Jill at jillonmoney.com. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money. And thankfully, the break came at the perfect time for me because we had Marianne asking about a portfolio question and a product question. If you've got a question about your retirement assets, if you've got a question about perhaps your allocation, or if someone is trying to sell you something and it doesn't quite feel right to you, why don't you send us an email? Our email address is askjill at jillonmoney.com. So, Marianne, registered nurse, by the way, thank you for being a registered nurse. Thanks to all of our healthcare workers. This is a very interesting question because you have a lot of issues here. Number one, someone's trying to sell you an annuity. Do not do it. Absolutely do not do it. My next issue is that the person who's probably, I think, managing your money is not a money manager or an investment advisor. This looks to me like perhaps this is a commission based broker. I think I'm not sure. I don't want to, if I'm wrong about that, let me know. But I was looking at some of your holdings already, and you've got a lot of these things like the Ivy fund family. So, Ivy is a type of fund family that's usually commission based. So, just for fun, I went in the middle of the break and said, well, what is the expense ratio for, say, the large cap growth fund that you own? And the expense ratio is 1%. And that's just a lot of money to pay for a big domestic fund. Whereas, if I look at your investments, say, in your retirement account, which is a much more reasonable, by the way, they're Fidelity. And Fidelity is going to be a much better, I think, way to look at your world than anything else. So here's what I would say. Number one, don't do the annuity. Number two, I think that you've got a bunch of money that's saved. And to generate more income, we would have to start to look at some of the other money you have and really kind of make a decision about what's the best way forward. I'm not 100% sure. I mean, like you say you need $4,500 to $5,000 a month. Well, you know what? You're going to have $3,600 in Social Security. The pension's $1,000. So I don't know why we are considering this annuity in the first place. And number two, I'm not really keen on the way that the money's currently invested that this investment person has anyway. Okay. Sandy writes, I very much appreciate your crisp advice. My only compliment is that we can't hear more of you daily. You know what? Thank you, Sandy. But let me be clear that this is just the perfect amount. Mark is complaining that he hears this much of me and he has to listen to me in his sleep because my voice that he edits all the time. Anyway, here's Sandy's question. Which should I put more money into paying off sooner, my student loan or my mortgage? Or should I split and pay a bit more to each? Should I pay them each down at the current rates and stick extra money in my brokerage account? Okay, here's a quick background. All retirement accounts are maxed out. Great. Emergency fund, where I want it to be. Great. No other debt. But here are the two loans that are outstanding. We have 112. Oh, I'm sorry, that just hurt. $112,000 at 4.25% for 10 more years. Mortgage, $280,000 at 4.5%, 20 years. Can we refinance this mortgage? I'm thinking you should check this out. You didn't tell me how much your house or your condo is worth or your co-op is worth, but I think that it's worth checking out whether or not you should be thinking about a refi for the mortgage. So at least just inquire about that. Beyond that, if you cannot refinance or it doesn't make financial sense for you, what I think you should do is to rapidly put extra money towards your student loan and pay it down as quickly as you possibly can. And that's it. That's what you should do. All the money. I mean, paying down that 4.25 note, I think that's going to be great for you. And I think you will feel so much relief when that actually occurs. Okay. Nick writes, I am almost 40, and with my spouse, we have about $1 million of retirement money. Fantastic. Way to go. All of it is in passive funds. So passive meaning, I mean, I know most of you know this, but just in case, a refresher means that usually it's an index fund. It's a passive fund. A passive approach would be that you basically put the money to work that mirrors an index, and then nobody actively tries to outguess which stock or bond or other asset that can beat the index and actively manage the fund. So Nick writes, he was convinced that passive funds were the way to go given the low cost and the long time horizon. Of late, writes Nick, I'm concerned that as more people invest this way, there may no longer be effective price discovery in the market when older passive investors start to retire and draw down their funds. Our investments could deflate substantially. See the work of Michael Green. Have you given thought to this phenomenon? Is there something reasonable I can do to mitigate the risk? Should I continue just sucking away my money into these large and cheap funds and ignore the market? Thanks, Nick. Nick, you should do exactly that. You should ignore the market. I know that there are a lot of people who say that index funds, that there could be a problem. I don't see that problem being something that you should be concerned with. I really don't. I think that in essence, the issue here is that many people want to sort of beat up on the index fund world. And yet, we still haven't seen evidence that there's a better way to invest. I would like to point out to you all, if you haven't read it, from maybe Mark, I'll send this article to you. Wait, listen, you can hear this. That's an actual that's a physical newspaper that I cut out. Meyer Statman, very smart behavioral finance dude, wrote a great article in the Wall Street Journal Tuesday, September 8th. And the headline is Investors Still Believe They Can Beat the Stock Market. I can't even tell you that there's just evidence upon evidence and reports, all of this stuff. It does not pay to try to outsmart the market. It doesn't. And that's why we have absolutely come down on the side of passive investing. If someone starts to show me that there is a fund manager, there is people who can consistently over time beat the market, sure, that's great. We just haven't found that person. Yes, there will be somebody who can do it every so often, but it is very rare that I have found or run into somebody who says, I can do that consistently, and I haven't seen the evidence that shows that. Okay. All right. This is a note from Matt, who says, Hi, Jill and Mark. I'm a big fan of the radio show and the daily podcast. They keep me going as I navigate the brave new world. I've also read your book twice, The Dumb Things Smart People Do With Their Money. Thank you. Here's my question. My friend and I are having a friendly, but at times contentious debate. If you have to choose between buying a house versus saving for retirement, which do you choose? My friend is 41, wants to relocate back to the Midwest from LA, has a $60,000 inheritance, which is all the money she has in the world, next to what would be a tiny pension. She wants to put it all towards a down payment on a house. After that, the bulk of her income, which is uncertain due to COVID impacting her employment, would go towards the new home. I think she should focus on putting that money into retirement and investment accounts and rent. Of course, that's her decision. But she is saying that when she retires, she'll be able to live rent-free versus paying rent until the day she dies. She also thinks owning a house validates you and renters are wasting their money. I don't own a home. I rent because I live in a pricey market. And my career in the entertainment industry is unstable, especially now during COVID. However, I have a good amount of money in my retirement and investment accounts with about another 18 years to go until I retire. What is it about our culture that makes you think home ownership is the only way to build wealth, or that you're making a massive mistake by not buying a home? I think I know what your answer will be. Help us settle the debate. I'm not sure if it will change your mind. Maybe it would help other people listening. Thank you. Matt, you know that I'm going to tell you that I love renting, even though I don't rent myself. And I think that renting gives you flexibility. I think in a case like this especially, we see that somebody could actually put her life in jeopardy, her financial life in jeopardy by making this decision. So when we come back from the break, I want to talk a little bit more about that buying versus renting and why that's so important. It's Jill on Money. If you've got a financial question, ask Jill at jillonmoney.com. We'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money. If you've got a financial question, love to hear from you. Our email address is askjill at jillonmoney.com. And don't forget, we've got so much going on at our website, jillonmoney.com. You can read articles that I've written. You can listen to past shows. You can catch up on our podcast or subscribe to our podcast. And you can watch TV segments that have aired on CBS. And I really would love for you to check out the resource section, which Mark is building as we speak. He's always building something. It's fantastic. So check it out, Jill on Money. And if you're on the website and you've got a question along the way, just send us an email or just click the contact button if you're on the website. Very easy to do. Okay, so before the break, we were talking a little bit about buying versus renting. And one of the things that is really interesting about the country is that it took, I think, this pandemic to maybe prove to people that ownership is not necessarily the best thing in the world. Now, I'm not saying that you shouldn't buy a house. I'm just saying that in the instance of somebody who has $60,000 to her name, to take all of that money and plow it into a down payment on a house seems really insane. The other piece of this is that there's so much labor force mobility right now. And I know that people are saying, oh, I just want to buy a house and stay there and I'm going to work from home forever. You don't know that. We don't know what's happening next in the post pandemic world. Before you make a big decision, which may really impact the rest of your financial life, I would caution people to really start looking at where there's opportunities and what you can do to improve your financial lives. And it may be that tying up $60,000, the only $60,000 you have to your name, that may not be the best decision for you. In fact, that might be a foolish decision for you because you may find that, you know what? I really want that money. I really need to have that money available to me. So that is kind of where I come out. Please, please, please try to be careful with these decisions. It's simply not something that you can undo. That's the other piece of it, truly. Okay. Okay, here is a question from Anonymous. I know Anonymous's name, but he did say anonymous. Okay, 37-year-old physician working in private practice for about 5 years. Married, 3 kids. Up to this point, I've been focused on paying off debt and building up savings, having gotten off to a late start after medical school and residency training. My wife and I have eliminated all of our debt, including student loans, credit cards, and a mortgage. Wow. I have a generously funded retirement plan from my practice, about $300,000 saved so far. That's great, fully vested. Additionally, I make maximum annual contributions to traditional IRAs for me and my wife. Okay. The retirement savings are all in index based target date funds. Okay. I also contribute to 529 plans annually for our 3 daughters. Our annual income is about $600,000. We've saved pretty aggressively after paying off debt. I've got $500,000 in cash earning minimal interest in a standard savings account, well beyond what we would need as an emergency fund. I would like to start generating more passive income with what we have saved. What approach would you recommend? Should I do it all on my own? Should I seek out a financial advisor, a wealth manager? What's the difference between the two? Okay. Okay, Anonymous, here's the deal. I think that you probably could use some direction if you don't want to do it yourself. So, what I mean by that is you're beyond the index fund, target date fund universe. I think it's time for you to start to build a more robust portfolio. Of course, you make a lot of money, so you're making annual contributions to traditional IRAs, but they're non-deductible IRAs. So that's number one. Number two, the idea would be to build a portfolio that really maximizes taxable and non-taxable accounts or tax-deferred accounts, because you didn't say where you live, but I know that you're paying taxes, and we want to make sure that you're being tax efficient, which is something when you make a lot of money, you have to start thinking about. It's like one of the curses and the blessings. You make a lot of money, and so now you got to really start thinking about taxes. Okay. The difference between a financial advisor and a wealth manager is nothing, essentially. What you really want to know is, can I work with someone who has my best interest at heart? And so you do that by asking or interviewing folks who are fiduciary advisors. So that would mean that is someone who is maybe a certified financial planner or is a CPA who has a designation of a PFS, which is a personal financial specialist, I think, and or somebody who is who is a part of a organization called NAPFA, the National Association of Personal Financial Advisors. The most important thing to know is that Not everyone who's in the business of either wealth management or financial advice, whatever they call themselves, it's not clear that every single one of those people is actually a fiduciary. And the fiduciary is the vital aspect of this. If you want a low cost option for fiduciary advice, you could use one of these blended hybrid approaches, which are online approaches. So you may have heard of Betterment, which is one of the companies that does this. Vanguard has a service where you get an advisor and it's really cheap, but it's mostly online. Vanguard Personal Service Advisor, Schwab Intelligent Portfolio, Facet Wealth. Someone wrote in and said, hey, you haven't talked about Facet Wealth in a while. That's one that you should also check out. But most importantly, what you need to be clear about is whoever gives you financial advice should be working for you, should be putting your best interest first. And only those people who are fiduciaries at all times, those are the people who can do that for you. So if you need some more help with that, you can follow up with us. Tell us where you live. We may know someone in your neighborhood who could help you out. So check it out. And we have 10 questions to ask a potential financial provider, service provider, on our website at jillonmoney.com. Check out the resource section, the 10 questions to ask. Okay. Hope that helps, Anonymous. If you've got a financial question, send an email. Ask Jill at jillonmoney.com. We'll be right back.
401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money. If you have a financial question, we would love to hear from you. Our email address is askjill@jillonmoney.com. Ask Jill at jillonmoney.com. Okay, let's get to more of your questions. This is Karen, who writes, I love listening to your show on Saturday afternoons in Buffalo on WBEN. I'm hoping you could provide a quick analysis of my financial situation. I would love to. I love WBEN. Karen says, I am single, I'm 60 years old, and I am currently employed full-time. My income is approximately $60,000. Fantastic. Good for you. My assets, $185,000 in an employer 401k, and I am maxing out. Fidelity accounts, one inherited, $33,000, and a Roth at $30,000, which I'm adding to yearly. I inherited an annuity worth $90,000, money market account, $100,000, currently earning 0.8%. Yeek. That's a bummer. Okay, house paid in full, worth about $150,000. My question, the money market account. Should I be investing in something else? I do feel like I need to keep some money safe. I'm heavily invested in stocks in my other accounts. I plan to work another few years at least, but I would like to retire, I'm sure eventually. Thank you for your time and any advice you could provide. You know what, Karen? Couple things. It's okay to have a little bit of extra money in that money market account. I understand that. I wonder how much money you actually spend on an annual basis. That would be something important. And frankly, what might be helpful for you as you navigate this period is to start running some retirement numbers. Now, it's not as hard as it may sound. Okay. You can do this yourself, probably on Fidelity accounts. You can certainly there's a Fidelity calculator, maybe in your employer 401k. There is also the Choose to Save ballpark estimate. The American Institute of CPAs, AICPA, has a nice calculator. But I think it would be helpful for you to really sit down and run the numbers, because then that might give you some comfort. Now, let's presume that you maybe you do have too much money that is sitting in that account. Maybe it's just, I don't know, a little bit more than you really need. One thing that you could potentially do is you could take some of the money and you can have money invested in a non-retirement investment account. Totally fine. The other thing is that if you find, maybe you really don't want to take on that kind of risk. You really want to be safer. You could take maybe half of the money or whatever you really don't think you need, and then you could put it into a higher yielding boring account. Okay? So for example, let's say that right now you have this, 0.8% in a savings account, which is probably about as good as you're going to get. I'm sitting on the depositaccounts.com website, but maybe you could put some of your money into a longer term CD. Now, I mean, look, you're not going to do that much better, but could you get 1.5%? Maybe you could do that. And if not, I think that there is a case to be made that you could, again, have some money in a non retirement investment account. Nothing too crazy. It wouldn't be invested as aggressively as your current account. But let's back it up before you even do any of that. Run some retirement numbers, see if you're on track. I think that will help guide you and will certainly give you more peace of mind, Karen, because otherwise it's a little bit like flying blind. That's what I would suggest. Okay. Beth writes, "Hi, Jill and Mark. Thank you for making my commute to work fly by. I'm going to list some details. You can refer to them after I ask my question. I am married. We're both over 55. No dependents. We live in Washington State." Why is that important, ladies and gentlemen? No state income tax. Beth says, "My job, I make $70,000 per year and as stable as a job can be right now. My spouse makes $93,000 in a struggling industry, but so far has survived a 40% workforce layoff. Yikes. Okay. Both 401k plans offer access after 55 with no penalty. So that's good to know. They've got $1 million in pre-tax accounts, 350,000 in Roth accounts. We were 100% stock mutual funds until last year. At that time, I transferred 350,000 to a total bond fund. Oh my God, it's amazing. Good timing. Okay, so now current contributions back to 100% stock funds. Essentially, it looks to me like they're still tilted in a growth portfolio, but she says she's comfortable. Okay. Social Security will be $60,000 at their full retirement ages. They've got 10 grand in savings, $50,000 home equity line of credit that we could access for unexpected expenses. Current house is worth $500,000, 8 years and $153,000 remaining on the mortgage. I'm tempted to do a 30-year mortgage refi to lower our annual expenses by $12,000. The goal would be to keep annual income under the ACA, the Affordable Care Act subsidy threshold. Critical expenses, they're about $50,000 a year, so that $12,000 reduction would put us where we would need to be and allow our Roth accounts to keep growing. Question: is this a decent plan to hedge against employment and health unknowns for the next 8 years when Medicare would kick in? Is it a hard pass because I'm not considering something? Should we just suck it up and try to save enough to knock out the mortgage in one fell swoop? I appreciate your thoughts. Stay healthy, Beth. Okay, Beth, when we come back, I am going to give you one more alternative to consider. It's Jill on Money. Remember, if you've got a financial question, just send us an email. It's askjill@jillonmoney.com. We'll be right back. You're back. It's Jill on Money, and we are broadcasting from the Capital One Bank virtual studios. Capital One, this is Banking Reimagined. What's in your wallet? Okay, before we went to the break, we heard from Beth, who wanted to know about a refi. She and her husband are both over the age of 55. They've got just 8 years left on their mortgage, kind of stretching out the payments, and wants to know, how can we defend against a potential layoff? Our husband's in a struggling industry. Beth, I have to say, I think that it's fine if you really are tempted for this refi, but I think that you may be looking at this the wrong way. I think it sounds to me like you're very hyper focused on making every dollar that you have invested, or even every dollar that is in your name, efficient. When in fact, I believe that the answer to your question, how do you hedge against employment and health unknowns for the next 8 years, is right in front of your face. Bang out more money into that savings account. And I don't consider that a home equity line of credit is the way that you are protecting against unexpected expenses. First of all, a home equity line of credit can get pulled anytime. So if the blank hits the fan and you only have 10 grand in savings and your husband loses his job, you have no money. And it's very difficult to get that line of credit, the money out. Banks can just clamp down on that when they want. So the plan to hedge against employment uncertainty, health unknowns, is to have an adequate emergency reserve fund, which you don't have. I guess ostensibly you could pull money out of your Roth account, but I wouldn't do it. And if you're counting on pulling money out of your retirement accounts, well, you've already said that all of that's pretty much at risk. You've got some money in the bond market. That's fine. We need a healthy emergency reserve fund. That's what I need for you. If you're unwilling to make that commitment, then you've got to make sure that some part of your investment portfolio is really safe. So that's my advice. An emergency reserve fund, that's the key to your defense. Okay, next hour, we've got a great guest, so stay tuned. It's Jill on Money. Any questions? Send us an email, askjill@jillonmoney.com, or hop onto the website, jillonmoney.com, and you can click the contact button there. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome back. It's hour number 2 of Jill on Money, and we are broadcasting from the Policy Genius virtual studios. Policy Genius is the easy way to compare and buy insurance. Just go to policygenius.com. Oh, and by the way, check out their new online estate planning stuff. All right, so now it is the second hour, and we are delighted to broadcast an interview that we conducted before the pandemic. So we had a ton of stuff that was like basically in the can that we just couldn't get to. So now we're starting to pull some of those interviews out, and time to get something that is really hitting home right now. This is our interview with Howard Marks. He is the director and co-chairman of the Oaktree Capital Management Company. And he wrote a book, which is how he came to come into our studio, called Mastering the Market Cycle, Getting the Odds on Your Side. Here's our interview with Howard Marks. Howard Marks, welcome to the program. We start every show with a very important financial question. You ready?
Yes, I am.
Best financial decision or career decision you ever made?
Well, it was to start Oaktree.
And tell us a little bit about that.
I had 2 jobs. I worked at Citibank for 17 years and then Trust Company of the West for 10.
Mm-hmm.
And at the end of 94, my colleagues and I decided to leave to start Oaktree.
Why did you do that? I mean, you had a great career. What did you see that was going on in the 90s that made you want to do that?
Well, first of all, the funny thing about our business is if you reach a certain stature, you can go out on your own and the house doesn't get their share. So we were working for the minority of the fees. Mm-hmm. That was number one. Number two, we wanted to have a firm that ran our way. We have very definite ideas about how to run money, and over there, they ran money every which way, depending on the strategy. And when I became president over there, I was uncomfortable fronting for approaches I didn't agree with.
So what are those approaches that you founded this company with? Tell us a little bit, because this has to do with your book as well. So What is the approach that Oaktree took that was maybe different than where you were?
Well, all we did is we continued to run money as we had. I write. So we sat down and wrote out how we had been running it, and that became Oaktree's investment philosophy, which we still follow today. And the key thing about Oaktree is that all of the strategies follow the same philosophy.
And which is?
6 tenets.
Okay.
The first one says that the most important thing for the money manager is not making a lot of money. It's not beating the market. It's not being in the top quartile. The most important thing is controlling risk. And, we are in risk-prone sectors of the market. We don't do high-grade stocks, high-grade bonds. We do alternatives.
Right.
And I always thought that the best formula was to be the low-risk manager in high-risk asset classes.
How do you do that when you're in those high-risk areas?
Well, in each one, there are different ways to do it. But, for example, in high-yield bonds, which is where I started at Citibank 40 years ago, we buy single Bs. Now, in the last 10 years, the people who bought triple Cs and on down made more money. Mm-hmm. But I think it's more uncertain. And the clients who come to us want a high degree of reliability.
So you think that controlling risk is your first tenet.
Yes.
Can you compare that with the way that many managed funds do look at their, whatever, maybe they don't even have articulated tenets, but it seems to me that everybody's like, well, I just want to beat the market.
Right. Well, I think that's right. I think that for most people, beating the market is the most important thing and maximizing return. I believe that it's not important to beat the market when the market does well, which is most of the time. Our clients want to beat the market when it does poorly.
Right.
And if we can deliver, let's say, average return in the good years and above average returns in the bad years, we will have above average returns overall, below average volatility, especially good performance in the bad times, which is when I think you need it, and happy clients.
In addition to managing risk, what's
Number
the second
two is consistency.
Okay.
We and our clients don't have the objective of being in the top 5% of money managers in a given year, and we're unwilling to be in the bottom 5. They want consistency. Number 3 is we are only active in the less efficient markets where we think hard work and skill can pay off.
So that's really interesting. I just want to interrupt you for a second because I think a lot of people who listen to this show, they hear me talk about why are you buying a U.S. growth fund when you could buy the index?
Yes.
Explain what your decision and why that decision is different and what those markets present to you.
My first 10 years at Citibank were spent in the equity research department from 68 to 78. I ended up as director of research for the last few years. And then I was moving over to money management, and the boss said, what do you want to do? I said, I'll do anything except spend the rest of my life choosing between Merck and Lilly. I mean, there are such a thing. I went to the University of Chicago in the mid-'60s when they were just starting to talk about market efficiency. It's a concept that was developed there and taught there. And market efficiency basically says that if everybody understands a market, knows about it, has the data, is highly motivated to participate, and so forth, that their efforts will drive out of existence all the bargains, and everything will end up being priced fairly for the risk.
Right.
I believe in the concept of market efficiency. I don't believe that any markets are fully efficient. But as I say, I don't think you can, if you said to me, you can work here for the next 50 years, and if by the end of it, you have chosen successfully between Merck and Lilly each year, and you get a $10 million bonus, or otherwise you get nothing, I don't think you could do that.
Right.
It's like being a professional coin tosser.
So where do you think that there is market inefficiency? If the U.S. large cap market has some semblance of efficiency, and you're probably better off buying an index fund. Right. Where are the places and what parts of the market do you think that there is still inefficiency?
Well, we're active in non-investment grade credit, which means high yield bonds, leveraged loans, direct lending, private lending, mezzanine finance, and things like that. We're active in real estate and real estate debt, infrastructure, emerging markets, Japan. Anything off the beaten path. Now, some of these have gotten more efficient than they used to be, because if you think about it, knowledge is cumulative. People learn things. Once they learn them, they basically don't forget them. So there's a kind of an upward ratchet. And, now, especially with all the computer power, the internet and all that kind of thing, there's kind of no such thing as not knowing something anymore. You're sitting at dinner, you say, I love that movie. What year was that? And within 2 seconds.
I know. We used to scratch our heads saying, and we spend the entire meal, and then you drink a little more, and you really have no idea what the question was to begin with.
Exactly. But so it's tougher. everybody knows more today than they used to know.
In a place like in Europe, or do you feel like those are efficient markets? Are people going to be okay buying a European stock index, generally speaking, do you think?
I think the further you get from the U.S., presumptively, the less efficient the markets are. So Europe may be a little less than here, but not too much. But then if you get to Asia and Japan and emerging markets, I think you can find, and then ultimately the frontier markets, you can probably find assets that are mispriced. By the way, mispriced is not the same as cheap.
Absolutely.
Yeah,
right.
okay.
You want to just find a distortion
Yes.
and take advantage of it one way or the other.
Yes.
We'll get back to our interview with Howard Marks in just a minute. Hey, during the break, hop onto the website, JillOnMoney.com. There's all sorts of fun things you can do there, but maybe what you want to try is figuring out how to subscribe to our podcast. It's so easy. Podcast name, Jill on Money. You can go to our website. You can get it on Apple or Stitcher or Spotify, radio.com, Google Play, wherever you find your favorite podcast. We'll be right back.
Back to Jill on Money, where Jill Schlesinger helps you take the mystery out of your finances.
You're back. It's Jill on Money. If you have a financial question, boy, are you lucky. All you have to do is send us an email. It's askjill@jillonmoney.com. askjill@jillonmoney.com. Now, today we are presenting a great interview that we conducted with Howard Marks, director and co-chairman of Oaktree Capital, big money management firm. Guy has an amazing resume, really super smart. And I think that in terms of market cycles, you might think this is a guy who's advocating market timing. That's not what he's doing. That is not what he's doing. So let's be clear about that. But what's really interesting is to talk to somebody like this who has this deep history studying markets, being part of them at a time where we are seeing fluctuations that cause you to think perhaps that you may be able to time the market. Not so. Here is more of our interview with Howard Marks. Okay, so we covered your top three. Let's go to your 4, 5, 6 tenants.
Okay, number 4 is a high degree of specialization. So we don't have a central research department. Each strategy has its own research department. Each person is dedicated to one strategy. We don't have jacks of all trades. And each fund does one thing. So if somebody comes to Oaktree and they want an XYZ fund, high yield bond fund, as I say, I started at Citibank 40 years ago, and our high yield bond portfolios in 40 years have never owned anything but a high yield bond. That's not true of many funds. Many funds have some commons, some preferreds, some distressed debt, some munis, some sovereigns, other things to goose the return.
Is that because they got too big, or is it simply to goose the return?
Well, I think it's to goose the return. Okay. Back when I was at Citibank, my boss said to me, I was running convertibles and high yield bonds. He says to me, why don't you put some converts in the high yield portfolios? Because the stock market strength could add to the return. I said, well, I think that's a great idea. And I'll also put in some gold and some old master paintings. We believe in giving the client what they asked for. And if they want something else, we'll give them that too. But it should, again, be a knowing, conscious decision.
Interesting. Okay. Specialization. What's number 5?
5, to me, is one of the more interesting ones. Our investment actions are not governed by macro forecasts.
Okay, that's really interesting because so many firms have that super duper economist who speaks to all the clients and says, let me explain this to you, Mr. Klein, Ms. Client, Ms. CFO.
Let me tell you what's going to happen next year.
Right, and why do you not do that?
The macro outlook is very important. Macro drives the markets these days and has for the last, 15 years. I think macro took over from micro some time ago. But I don't think it's knowable. We don't have an economist at Oaktree. We don't have economists in. One of my good friends who is an economist who I started working with early in my career, which probably means the late 60s, called me a couple of years ago and he said, you know what, you've changed my life. I said, how is that? He says, because I've stopped making forecasts. I tell people what I see going on. I tell them what I think it means. And that's it. The point is, most forecasts are extrapolations. Everybody agrees with them. If they come true, it doesn't make anybody any money.
Right.
The forecasts that would make people money are idiosyncratic forecasts of deviation from trend. and they would be highly profitable, but they're rarely right. So what that says is that, to me, that you have consensus forecasts which are usually right but not profitable, and idiosyncratic forecasts which are potentially profitable but rarely right. Why do it? Why go to the trouble?
That's so interesting.
And to put it in slightly different terms, but really saying the same things, the goal, as you know, is to be a superior investor. If we are not superior, we have no edge. We have no reason for being. It has to come from seeing things differently and doing things differently and having a superior insight. And I just don't believe that it's possible to have a superior insight in the macro, which is economies, markets, currencies, and rates. We spend all our time trying to know the micro, companies, industries, and securities, and doing so better than others.
And all with a really close eye towards risk mitigation, right?
Right, yes.
Okay, so we do micro, not macro. Was that 4 or 5?
That's 5.
That was 5. What's a 6?
We're not the kind of people who go in and out of the market, cash, no cash.
Long term.
Yes, very, very hard to do that right. You know, if you go from an asset, let's say high yield, you sell a high yield bond that yields 6, you put it into cash, it yields 1, you better be right away. And it's very hard to do that right away. And then, by the way, you have to get back in at the right time. It's very, very hard to do that.
So in your new book, Mastering the Market Cycle, Getting the Odds on Your Side, you are not advocating market timing.
This is semantic.
Okay.
I think market timing is what I just described.
Right.
Getting in, out for the short term based on predictions of what the market's going to do.
Right.
And I think that's very hard to do. I don't advocate that. What I think is very important, and what we do and have done with good success, is that we alter our offense versus defense. Again, not based on forecasts, but based on observations regarding the here and now. So, for example, if I see that the market has been strong, that valuations are high on the back of pro-risk behavior, that tells me, I call this a process called taking the temperature of the market, and that tells me that we should be cautious, more cautious than usual. And that's what we have been for the last few years. If the market goes down and stocks are statistically cheap and everybody's suicidal and everybody's saying, that's it, I'll never take risk again, I say, okay, that's the time that we should get in because probably there's no optimism cooked into the prices of stocks. That's probably a time we should move forward.
And I think that that's really important because, you know, when we hear from individual investors who call into the program, they'll often say things like, well, I'm just so nervous about stocks, I'm going to get out of every stock. And I say the same thing, you're going to have to get 2 brilliant decisions, right?
Sure.
And now it's different than, hey, you know what? I'm playing defense. I made a ton of money in the stock market over the last 9 years. My position is swollen.
Right.
I used to be a 70-30 kind of investor, and now I'm 90-10.
Yes.
What is the advice that you would give to sort of the journeyman investor who's got $500,000 in non-retirement assets and $1 million in retirement funds, managing his or her own money? What is the advice that you think that person is not receiving, or what is the strategy that person's not executing?
Well, it's multi-layered, but let's take the person you're talking about. I'm nervous. I want to get out of the market.
Right.
Why are you nervous? I'm nervous because everything I read is negative. Everybody else reads the same negative stories. They're nervous too. The price of the stocks reflects their nervousness. That means it's probably not a time to get out. Maybe it's a time to get in. Most people sell when they're nervous and prices are low, and buy when they're confident and prices are high. Now, I was taught, I always say, my mother said, Howie, buy low, sell high. But most people buy high, sell low. So the first thing to notice is the importance of not doing so, the importance of not succumbing to crowd psychology, the importance of controlling your emotions. Doing what most people do, which is buy high, sell low, is the worst thing you could do. It's much better to just buy and hold. For people who can't make a superior decision on what I'm talking about, which I call cycle positioning, then I think that buy and hold is better than the default psychology of following the herd. Still better if you can do it, if you can devote the time and effort, if you have the experience level or have read enough, And if you can get your emotions under control, still better is to buy when everybody else is nervous and sell when everybody else is euphoric. And that's really what the book's about. So that would be cycle positioning. Now, the other thing I want to mention based on what you just said, I've had a great ride. I've made a lot of money. My portfolio has gone from 70-30 to 90-10. Okay, so here's my question to you. Based on where we are, not making a guess about where we're going, are things as attractive today as they were at the start of that 9-year period? And
No.
the answer is the S&P has quadrupled. The easy money's been made. The market may go up for the next 2 years. I'm not saying it's not.
Right.
But certainly it's not going to quadruple again in the next 9 years.
Right.
So that tells me that you shouldn't have as much risk today as you had 9 years ago.
Okay, we'll get back to our interview with Howard Marks in just a second. So here's some ideas of things to do during the break. Number 1, you can go to the website, jillonmoney.com, sign up for our free weekly newsletter. Number 2, you can buy my book, The Dumb Things Smart People Do With Their Money. Number 3, bookmark it and come back to it later. Okay, we'll be right back.
Do I invest here? Should I put my money there? Jill Schlesinger can help you. Back to Jill on Money.
You're back. It's Jill on Money, and we are about to conclude our interview with Howard Marks. Again, this is somebody who has been studying markets and managing money for decades, and he wrote a book called Mastering the Market Cycle, Getting the Odds on Your Side. And in this segment, we dive into a topic that's really important right now, and that is risk tolerance. The reason why this is so important is that, in the last 6 months, haven't you noticed that when markets are booming, you feel very bold? You feel perhaps like you can manage any risk that is out there. And then what I'm asking you to do is go back in time, go back to March and think about how bad you felt. And now you've got to manage those two emotions to try to figure out what is your true risk tolerance. Now, again, this interview with Howard Marks was conducted before the pandemic. So I don't want you to, we're not, being silly here. Obviously, we would have talked about that with him at the time, but the ups and downs of the market, those events can often throw you off what your real risk tolerance should be. So in the concluding part of our interview with Howard Marks, we're talking risk tolerance.
Think of this as a speedometer on your dashboard. It goes from 0 to 100. 0 is all cash. You're terrified. You think the market's falling apart. You think that nobody else has figured it out yet, so prices are high, so you get out. You go all to cash. Can't lose money, can't make money. 100 is fully invested in aggressive assets and maybe using some leverage. To do that, you would have to say everybody else is suicidal and the prices are on the floor, so it's worth taking max risk. I can't imagine ever being at 0 or 100.
Right.
But the first thing that every person should do, and I doubt many people do this, or even perhaps organizations, is you should say, where should my normal risk position be? It depends on who you are, your age, your financial condition, your earnings, how your earnings relate to your spending. Are you making more than you need or less? How many dependents do you have? How old are they? What are their needs going to be? What is your emotional makeup? What is your ability to bear risk and hold on through tough times, which is the most important single thing in investing? You think about all that and you say, okay, I'm 30 years old. I've got a good career. I'm married. I don't have any children yet. I can take risk. And by the way, I make more than I need. I put some money aside every month. So I would say, okay, you're an 85. And by the way, and I'm tough. You know, I've been through this before. It's not my first rodeo. I can live through a dip.
Right.
So I say you sound like an 85 to me.
Right.
And you agree. Okay.
Right.
And it's different for everybody. You know, age is very important, retirement status, etc. So the second question is, what about today? Should you actively manage your risk position relative to the normal position? That's question 2A. And 2B is, if yes, what should you do today? I would argue that you should have less risk in your portfolio than normal. So if you're an 85, maybe you should be a 65 today or 70. And if you, Jill, are a 70, then maybe you should be a 50 or 60. But how many people do this out of 100? How many?
I think very few.
Yes, very few.
I think even fewer. I think that professionals don't advocate for it because they don't want to be on the hook to have the disappointment. I think that they're all a bunch of wimps because if I don't hit the mark on the index, then I'm going to lose money, and then my business goes kaput. And who am I helping then?
You're right. FOMO, fear of missing out, is a dominating emotion, and as you say, not being in the market represents career risk for the investment professional. As we started off the interview by saying, failing to keep up with the market is not the worst thing in the world. Look, I believe that when the market is risky, you should cut your risk. The first of the great adages that I ever learned was that being too far ahead of your time is indistinguishable from being wrong. Where if we do these things, even if you do the right thing in the investment business, you rarely do it at the right time, which means you're going to reduce your risk. The market's going to keep going up. You'll feel stupid. You may lose some clients if you're a professional. But what about doing the right thing? One thing you have to accept to be an investor is there is nothing you can do that will always work.
Thanks again to Howard Marks. The company is Oaktree Capital. The book, Mastering the Market, Getting the Odds on Your Side. So really kind of cool. I always love talking to people who've been investing for a long time. It does put things in perspective. So, okay, let's do some questions right now. Sonia writes, in 2018, our adjusted gross income was over $200,000. Therefore, we did not receive a stimulus check. However, in 2019, my husband was unemployed for almost 6 months, and our adjusted gross income was under $175,000. I did not file until July 15th. Am I now eligible for that first round, or do I get to claim a credit when I file for 2020? Well, you should be eligible. It may come, I don't know how the IRS is doing it. They are generating that credit. You don't have to file anything. You filed your taxes. So I know that they are proactively sending out these checks. So we'll see if you get something. Okay. Juan Carlos writes, this is so nice. I'm grateful for the podcast because it's daily, and that's nice that he says that. Okay, I recently sought to open a Roth IRA with Vanguard, and I'm a rank amateur in the world of investing. I'd like to purchase index funds instead of individual stocks. My question, he's basically torn between the exchange-traded fund or an index fund. And is there any advantage or disadvantage to either? Not really. I mean, look, I think the index funds are pretty easy to use. Obviously, there's free trading right now. It used to be that exchange-traded funds cost some money for trading, but there isn't really much. Everything is available to you. You could do either. It might be easier since you're just starting out just to use an index fund. I don't want you to be trading intraday, which is the main difference between the two funds. So I say, let's just keep it simple. Do the index fund, call it a day, and go to sleep at night. So we got to go to a break right now. But here's something really cool you could do during the break. Juan Carlos listens to us daily, right, on the podcast. Do you want to do that? You should. Podcasting is just like radio, but you get to listen to it whenever you want. So here's how you do it. Subscribe to our podcast, Jill on Money. You can get it on Apple or Stitcher or Spotify or radio.com or Google Play. Or find somebody who knows anything about podcasts and they'll show you how to do it. Just search for Jill on Money. Okay, we'll be right back.
(401ks, IRAs, refinancing, she covers it all. Back to Jill on Money with Jill Schlesinger.
You're back. It's Jill on Money. If you have a financial question, you have a tax question, you have a real estate question, why don't you send us a note? It's so easy. Ask Jill at jillonmoney.com. And if you're on the website, just click the contact button. By the way, if you're also on the website, why not sign up for our free weekly newsletter? It's free and happens every week. How about that? This is a follow-up question from Alexis, who's 25 years old and lives in Las Vegas, Nevada. And I had answered the question, and she followed up with some more information. And just to give everyone a little bit of the background, 25 years old, $50,000 in different money market accounts, and trying to decide whether or not buying a home is the right option for her right now. Okay, so she follows up and says, I'm so happy you replied. Thanks so much. To give a little more information, I do have a 401k with my employer. Get an 8% match, and I max that out with each check. It's the only retirement fund I have. They also throw in $2,500 to $5,000 bonuses into our 401ks each year, depending on the performance of the company. That's great. I've looked into index funds, which I initially wanted to invest in the S&P 500 during the dip at the start of COVID. Now it keeps going higher and higher. I'm trying to find a good time to get in. Uh-oh, Mark, what kind of market timing is this? How are we going to wring that out of you? Don't worry about the market. Just get that money in the funds and stick to a game plan. There's no debt besides my car. I've got $9,000 left to pay on the card debt. I am currently invested in individual stocks. When looking at a home here in Vegas, they just built a stadium. I want to get in, blah, blah, blah. The homes that I'm looking at are new construction. What do you think? Thanks so much again. So two big questions are, if you're dying to buy a house and it makes sense and you've run the numbers, then sure, why not? I really encourage you to go and use the calculator. We have it on our website, the New York Times rent versus buy calculator. You can look at that. You're still putting money into your retirement account. That's good. I would probably max out my retirement account, not just 8% up to their match. I would put in as much as you could. I would have your emergency reserve fund. I would pay off your card debt. And I'm not sure why you're invested in individual stocks versus index funds, but maybe that's just for fun, I guess. I don't know. So if you're hell-bent on buying a house, then run the numbers, make sure it makes sense, make sure you have a bigger emergency reserve fund than you think you need. Because I promise you, owning a house, even new construction, is going to be expensive. Have I missed anything else, Mark, on that one? I think that sums it up too. Okay, one more follow-up. This is from Ramona, who, let's see, what did Ramona want to know? Which was mid-40s, and they want to retire, by 55. They have a net worth of about $850,000. They've got retirement plans through employers. The question was, since we're planning to retire early, is it better to max out both retirement plans and a smaller, or, does it really matter? So the question I asked them, who provides the plans? Okay. She has TIAA CREF, which is a deferred comp. He has a Fidelity account. I mean, look, I think TIAA is amazing. We just had Roger Ferguson, the CEO of TIAA, in the studio earlier this year. I think that maybe I would just stick with TIAA and maybe not so much that he's retiring sooner, but I really think TIAA is a very, very good option, and it gives you a nice, consistent an annuity contract that's cheap and accessible. So I think that would be good. Okay, this note is from Michelle. And Michelle writes, my birthday is in October. Oh, just around the corner. And at that time, I could start receiving my Social Security. It's my full retirement age. But is it better to wait until the beginning of 2021 because I would have yet another year of higher earnings replace a lower year in the calculation of Social Security? Is that the correct thinking? I always enjoy your show. I mean, first of all, if you're still working, why are you collecting Social Security now? I guess just because. I think that unless you need the money or you are in very poor health, the idea of delaying Social Security really has more to do with, yes, you might be earning more, but it's really about the Social Security calculation is in your favor. So from your full retirement age up until age 70, by delaying that benefit, you collect about an extra 8% a year. And that's 8% a year that's risk free. So in my mind, risk free 8% ain't so easy to get these days. So I think that there could be a really good opportunity for you to delay again, unless you need this money for something I'm not seeing. So if that's the case, let me know. But otherwise, wait as long as you can until 70 if possible. Okay. It's Jill on Money. If you have a financial question, don't forget, send us a note. It's very easy. Ask Jill at jillonmoney.com. We'll be right back. You're back. It's Jill on Money. We're broadcasting from the Policy Genius virtual studios. Policy Genius is the easy way to compare and buy insurance. Just go to policygenius.com. All right. Before we finish up the program, let us take another question. Here is Dave, who writes, Jill, keep up the good work. You're nonstop amazing. Oh, thanks so much, Dave. I did stop a little bit. We took a nice break. Okay. As they say in investing in retirement, it's not what you earn, it's what you keep. So what do you think of my tax avoidance strategy? I'm 60 years old. I'm retiring probably around age 65 and ish. Would take Social Security at 70. My wife and I have these bucket percentages, 61% pre-tax in a 401k, 11% in a Roth, 6% in cash, 22% in a taxable account, about 400 grand in individual growth equities. Okay. With the taxable account, I'm planning to avoid capital gains taxes during my gap year, 65 to 70, by selling the securities while staying under the $80,000 annual income when capital gains taxes are zero. That's so good. Okay. Our spending is under 80,000. Long-term gains on these securities, if we sold today, is about 200 grand. Could grow much larger in 5 years, which would be a boatload of taxes. My plan would avoid it all if properly executed. Any fatal flaw in the tax avoidance strategy? Only one, my friend. And you know what it is. Those capital gains rates, they may not stay this low. So I think that there is a high likelihood that perhaps you may have to stretch out your plan over time if capital gains were to rise. Doesn't mean that you can't execute it over a longer term, but you also may want to consider, I don't know if you guys are charitable at all, but maybe that's something to consider. But remember, when you have to start pulling that money out of those pre-tax accounts, your income could rise. So all of this could be moot if a capital gains rate change kind of blew up your whole plan. It's okay. There may be other things to do. Let's kind of see how things go. For now, fine, you can execute it, but just know that plan could come under scrutiny later. Okay, it's Jill on Money. Thank you so much for listening. As always, please wash your hands, wear your masks, maintain your physical distancing, and do something nice for somebody else today. Please, it'll make you feel good. We'll talk to you next week.